What we want to do now is just focus on what's happening out there in the markets right now. And I want to start with some context, because I think it's quite clear, whether you're talking about the occupier or the investment markets, that what we see happening in property at the moment is very, very much being driven by the big macro events that we see in the world. From an economic point of view, it certainly is true that Asia Pacific and certainly China have been showing stronger economic growth than most of the rest of the world. The bars here in blue are global GDP growth, and you can see the green line for Asia Pacific is well above that line. That still, we hear, leading to discussion about so-called decoupling, the fact that Asia is capable of somehow moving on its own and is therefore not going to be impacted by what's happening elsewhere. I think that the bottom graph here really reveals that for what it is, which is simply untrue. What we've done here is two things. Firstly, we've just changed the scale by which we're measuring China. There's no question China has a higher growth rate, it's absolutely true, than most of the rest of the world. But actually, if you just change the axis, look at how it moves relative to the rest of the world. More particularly, if you look at the green line in the lower chart, has taken out China from the rest of Asia Pacific. And what you can see is that although the growth is higher than in some other regions, it's certainly not materially so. And the crucial point is all of these lines are, to all intents and purposes, moving together. I would argue that far from decoupling, the world's economies have never been more joined up, and in many ways they are getting closer and closer together with ever more complex linkages. As a result, I'm not saying that Asia isn't in some ways insulated from what's going on. It is, and there's more dynamism and more interconnection between the Asian economies, which is certainly helping. But any idea that Asia is somehow separate and not going to be influenced by what's happening in the rest of the world is quite frankly nonsense. And we should be very wary about any suggestion that that might be the case. And we can see these are the consensus economics, consensus forecasts, expectations. Each month, a group of economists are asked, what do you think GDP growth is going to be in 2012 across different markets? And you can see that last August, when we had all the renewed fuss about the Eurozone debt crisis, the US debt downgrade, that's when sentiment really started to change. And you can see how in the top chart the expectations for the major regions have declined, started to stabilise again a bit, but clearly the hardest hit being Europe, where from expectations of sub-trend but 2% growth, we now expect a recession in 2012 overall. The lines at the top covering Australia and parts of Asia may not look as though they've moved very dramatically, but look at the bottom chart. Same numbers, but for the more open trading economies, Hong Kong, Singapore, South Korea, Taiwan. Look at how those events have affected expectations for growth in this part of the world, and indeed, having stabilised in the first quarter, 5 months of the year, we've now seen renewed concerns following on from what's happening principally in Europe. I think that it feels as though in Europe we're coming towards some kind of end game one way or the other. I think it's very noteworthy that the result of the Greek election on Sunday was pretty much as good as you could have hoped for. And at the same time, the bounce that we saw in the markets lasted maybe 36 hours. The markets are not willing to tolerate expectations that something is going to get done at some stage at the moment. There is real concern, and I think that the biggest issue out there right now is Europe, and the markets are looking for very clear action one way or the other as to how it's going to be resolved. So when we start looking at what's happening in real estate, it's very important to bear in mind this very uncertain economic and political environment. There's huge political risk out there all the way around the world at the moment. It's not just Europe. You've got the slowdown in China. There are concerns in the Middle East. Obviously, the only reason we're not hearing as much about North America at the moment is because we're hearing so much about Europe. But North America certainly has its own challenges. In terms of Asia, longer term, there's still a huge amount of confidence about the region. Everybody believes this is going to be the area of the world that drives global growth probably over the next 10 years, at least. But short term, these concerns and this crisis in confidence globally is certainly having an impact on both occupiers and investors. And that's what I want to just spend a couple of minutes talking about. From an occupier point of view, it's always dangerous to generalize, but I think broadly speaking, there are two groups of major occupiers in our markets that we need to think about. The first are the major multinational corporations. By definition, they're likely to have significant exposure to the direct markets in Europe and North America. In many cases, those are the biggest parts of their business. And quite clearly, they are very risk averse at the moment. They're very nervous. People are behaving on the basis of surviving what may happen in Europe, and that could get very ugly. So people are tending to hoard capital and hoard cash. In general, that means even in this region, whilst they've got one eye on future growth expectations and positioning themselves for the next 10 years, right now, they're trying to avoid making big capital commitments, big decisions, if they can. It's not universal. We're still seeing companies making those investment decisions, but generally there's a much greater air of caution and those decisions are taking longer to come through. Particularly, obviously, the finance sector and those that are most directly related to it are much more cautious. That said, I must say, the insurance sector is still growing very, very rapidly, largely off the back of very strong premium growth coming through in Southeast Asia. The retail sector, not just in terms of retail space, but in many markets in terms of the office space they occupy, are also tending to expand relatively more strongly. And although the China slowdown may have a bit of an impact, generally anybody who's doing anything related to commodities is also seeing strong demand coming through and also expanding. But the other group that are slightly different are the domestic occupiers, those that are more focused on national or the Asian regional economy. I said there's no decoupling, and I would still hold to that, but there's no question that for many companies that are focused particularly within this region, demand is still stronger. Economic growth in most markets of the region is at least 3.5%, even in the more mature economies, through 4, 5, 6, 7, 8% as you go through from Southeast Asia through up to China. So there is still a lot more activity, and generally what we're seeing is that domestic regional companies are tending to be more aggressive and expanding more rapidly, and in some cases, as we'll see, they're still driving rents up quite significantly, particularly in some of the Chinese markets. So that caution, that just sort of pullback in terms of the bullishness that we saw coming through 2010, early 2011, is quite evident in the markets. The bars here show total net absorption, the change in occupied office stock across the largest 15 or 20 markets in the region. And you can see it's still positive, but actually, with the exception of the extreme period in 2008-9, actually probably at one of the lower levels that we've seen over the course of the last 6 or 7 years. And the vacancy rate shown by the line, which was coming down very aggressively, has actually started to flatten out. We're not seeing vacancy rising yet, although I have to say that one of the areas that Asia is different from the rest of the world is that there is a significant development pipeline in quite a few markets. So it's possible that we're going to see some of that supply hitting the market in some cases at the same time as we've got a bit of a weakening of demand. So short term, some of those markets could well come under pressure. Here you can see that development pipeline relative to the size of the market, so shown as an effective vacancy rate. And you can see particularly in India, we haven't got all the Chinese markets on here, but in a number of the Chinese markets, that supply pipeline is very significant. But of course, a topic that I suspect will be very familiar to many of you. If you've heard Mr. Farrelly speak, it will be tattooed on your brain. Look over on the far right-hand side, Hong Kong. Even though rents have been coming off in Hong Kong, we do expect this very low level of vacancy, and particularly the very low level of development activity in the market at the moment, to eventually provide a support for rents, and there is some potential that we could be seeing that starting to happen right now. But particularly when demand does come back to the market, we could see quite a sharp bounce. So in terms of the occupier markets and rents, the Asia-Pacific average, and bear in mind Kevin's comments about average regional indices here, I would echo those. But in terms of generally what we're seeing is the recovery that we saw in rents coming through 2010, 2011 in the major office markets, to some degree right the way around the world, if you were looking at the better quality space at the top of the market, that momentum has very much slowed pretty much wherever you look. And it's a common global theme, and it's very understandable given the nature of the economic and political concerns out there at the moment. Just focusing here in Asia on the movement of top rents, grade A, top grade A rents in the first quarter, and quarterly numbers can clearly be volatile, but actually I think this is pretty indicative of what's happening. Beijing, one of the markets which is still seeing quite strong demand, but actually very, very little supply, and relatively little supply coming through over the next couple of years. So there we're still seeing strong rental growth coming through. Many more markets seeing now minimal growth, or many more than are shown here on the chart, actually static at the moment. And in some cases, notably Hong Kong, Singapore, Tokyo, the very top rent edged up, but actually structurally there's still some downward pressure on rents in Tokyo. So in many of the major markets, we're seeing rents actually starting to decline. So if we position markets on the office rental cycle, you can see that there's a huge disparity between different markets. This isn't just quarterly movements, this is trying to identify broadly where in their cycle do we see the markets to be. And you can see that those that had been growing very rapidly now just starting to slow, or in some cases top rents just coming off. In other cases, markets that were actually in the relatively earlier stages of what we regard as an upward cycle in rents. But I think the common theme that we see throughout the region is wherever they are in their cycle, the upward momentum that we were seeing has very much slowed, and we wouldn't expect to see much more upward mental movement, and we may see some falls until we start seeing a significant recovery in occupational demand, which I have to say in most markets now looks unlikely to start feeding through until certainly the early part of next year at the earliest, although again in Hong Kong we're starting to see some of the first signs of some demand coming back, which is encouraging from an investment point of view. So that's the occupier side of the market. What about the investment side? Well, clearly it'll be no surprise that having gone through a series of potential dawns that have turned out to be false dawns, investors remain very nervous. They're generally very risk-off around the world. In that environment, prime property actually looks very, very attractive. The combination of being a real asset with a high proportion of embedded value in the land and the built real estate gives you an underlying security to real estate investments that is very highly favoured most of the time here in Asia, but is particularly attractive to investors right the way around the world at the moment. Clearly, as and when recovery comes, there's also the opportunity to benefit from a combination of either rental growth and or further yield compression as and when the economy recovers and investors get more aggressive. Now, that is all true, but obviously in markets where there is very uncertain economic outlook, it only applies to the very best real estate. Because buildings which have got vacancy impending or current at the moment, or where shorter leases or poorer quality locations are far more vulnerable to the economic cycle and to the demand cycle. So around the world, what we're seeing is very, very strong investment demand coming through for prime assets, a focus on quality of building, quality of location, particularly the lease length and the covenant of the tenants, and preferably in the larger and more liquid markets where investors are able to trade in and out more easily. So what we're seeing is very strong yield compression, very strong demand, particularly in the global markets. We're seeing it in Tokyo, we're seeing it in London, and to some degree in Paris. We're seeing it in the top six gateway cities into the US. Very strong demand. Despite the economic weakness, it's almost because of the uncertainty in the world that these are assets that investors are looking at. And here in Asia, that core type of investment is obviously quite difficult to do. There are relatively fewer assets of this type in the market relative to the size of the market than there are in other markets. And many of those assets are quite tightly held. Investors aren't trading them at the best of times. They're certainly not tending to trade them now. And even when they do, what's often a surprise to many international investors coming into the region, there is of course absolutely no shortage of capital here in the region, and so anybody looking to buy faces stiff competition from that domestic capital. So as a result, the pricing of real estate has been quite aggressive, and indeed you can see quite clearly from those returns, Hong Kong's probably one of the best examples. A lot of that has been driven by rental growth, but also by very low yields coming through in these markets. If we look at the capital value growth we've seen, however, it's probably not a surprise given that we've seen rental momentum easing and yields have been pretty tight throughout this cycle. There's no surprise that the growth in capital values that we've seen has started to slow over the course of the last couple of quarters. It's potential that it's possible that it could turn negative. We have seen some negative movements in some markets, but in general, certainly if you're looking at the better quality space at the top end of the market, supply is significantly lower than the volume of capital that we've trying to get into the market. And we think that unless there is really some catastrophic meltdown from an economic point of view that really does undermine the level of rents being paid and the level of demand, in general, we think that capital values, even at their quite high level, are likely to be reasonably well supported. Although it is worth pointing out that in some of these very, very high value markets where rents had got quite high and where yields are still very low, the markets are vulnerable to any big external shock that comes through, like we saw in 2008, and that's something that investors need to factor into account. You need to be able to survive that period as and when it comes. The yields that we see in the markets are very low, and particularly here in Hong Kong, in Japan, to some degree in Singapore. It is worth bearing in mind that when you're looking at the level of yields, you've got to compare it, you've got to put it in context. You know, yields on short-term paper, short-term government bonds in Germany and some of the yields that we saw in the US have actually turned negative in the recent past. In other words, people are paying secure governments just to hold on to their money for a couple of years because they're likely to give it back. Now, in that environment, the sorts of income returns that are being generated off these sorts of initial yields that Kevin referred to earlier, and you can see here, are actually reasonably attractive, particularly if you've got an asset-backed security behind it rather than just a bit of paper. And also worth noting here on the left-hand side of the slide, the relatively higher levels, even of initial yield, that we're seeing in Australia, and there's no question that that's a market that many people have been looking at as potentially attractive, largely for that reason. In terms of the volume of investment activity that we've been seeing, we were actually quite surprised at how volumes held up through the latter part of last year. In fact, a lot of that was deals just taking longer to get over the line than had been the case previously. And in fact, it was no surprise to us that the volume of activity fell away quite sharply in the first quarter. You have to be careful with quarterly numbers, and the first quarter is quite often relatively a slower one. But we'll have to wait and see. But I think right now, in general, that lack of that shortage of confidence and a shortage of sellers in the market in many cases has meant that we're seeing deal volumes a bit lower than they have been. Again, just looking first quarter relative to the fourth quarter last year, you can see this wasn't just one or two markets. Pretty much across the board, we saw investment volumes and completed transactions fall away quite markedly. You may note in there, actually second one down, the exception is Hong Kong. Hong Kong's actually shown a rather different pattern of investment activity to what we've seen elsewhere. The latter part of last year, particularly if you were to take out Swa's disposal of Festival Walk in the third quarter, the latter part of last year was actually relatively quiet from a Hong Kong point of view. And then in a marked switch with the rest of the region, we saw volumes pick up very strongly in the first quarter, and we've actually got sort of provisional second quarter numbers which are up to about the middle of this month. And you can see again, even though the quarter isn't over yet, we've seen quite strong activity here in Hong Kong across a number of different sectors, a number of retail transactions, but also office volumes picking up a bit after the downturn that we saw last year. So that's something that I'm going to pick up with the panel a little later, but the line here shows the rolling 12-month total, so each 12-month period up to the quarter shown, and you can see that the volume of activity that we've seen in Hong Kong is actually higher than we had recorded at any point in the last 5 or 6 years. So clearly something slightly different going on in Hong Kong at the moment. From a value point of view, you can see here, this is actually the government's rating and valuation data, looking at the three major sectors, splitting out Grade A offices, and you can see the very significant effective doubling of values since the bottom of the market in the middle of 2009. And I think the picture tells its own story. Even the largest recession that the world has seen since the Great Depression in the 1930s now looks little more than a blip in Hong Kong's capital value upward progression. There is probably lots of issues to discuss around that particular topic, but clearly you can see why we're saying that to some degree the market is potentially vulnerable to a significant external shock, albeit, as I say, that we do think that the fundamentals are there to underpin demand. Finally, because I want to get on to the panel discussion, just to comment on the flows of capital that we've seen around the region. In most markets, domestic capital still tends to dominate. Here what we're doing is looking at cross-border investment, again on a rolling 12-month basis, so each bar shows the previous 12 months on aggregate. And what we're doing is looking at the net investment by two groups of people cross-border. One is, with the lighter bars, is capital effectively coming into the region through international funds or international investors. Second is Asian capital moving around the region. It's difficult to put a precise nationality because a lot of the vehicles that we see have got lots of different international money inside them, but we do try and take that into account. What you can see is a very clear shift in the pattern, and this I think is true, that since the onset of the financial crisis, global and international funds have consistently been net disinvestors in Asia. They've been selling more Asian real estate than they've been buying. In contrast, the dark bars are what we regard as Asian money moving around Asia, a lot of it going through Singapore. The major funds and the listed REITs in Singapore have been amongst the most active in the sector across the region. And what you can see is that they have been buying more real estate outside their own markets than they've been selling. A very marked shift in the pattern that we saw in the run-up to the global financial crisis, and for various reasons that we're happy to discuss later, a pattern that I think we could well see continuing into the recovery phase, with actually investment capital from Asia tending to be dominant. Where are people buying? It's pretty clear that a huge amount of the interest is focused on China generally, but particularly the retail sector in China, Australia, across most sectors, but also the industrial sector, where they're seen as good growth potential and potentially easier to buy. Noteworthy that the markets in 2011 that saw lower activity materially than 2010, some of the principal office markets in the region, partly because of a lack of the best quality stock available to buy, but also to some degree because of concerns about the prospects for that sector relative to where pricing stands at the moment. So in conclusion, I think that we need to get used to this, this uncertainty that seems to have been around forever already. But I think that we face still a lot of uncertainty in the world, and that's going to remain the case. If particularly the European situation does manage to approach some sort of conclusion, and provided none of the other major concerns and issues that are out there actually go thermonuclear, then I think that at some point we're likely to see quite a material shift in confidence. When investors, and particularly occupiers, international occupiers, come out of this money hoarding, risk-off mode, we're likely to see quite a sharp bounce back in activity because their shareholders at the moment are happy for them to sit on cash earning no return, because it means the company's going to survive. When we move out of that risk-averse environment, shareholders are very quickly going to expect companies to put that money to work. We think that that's going to lead to two things. Firstly, a significant resurgence in M&A activity, which particularly in this region, which could well provide a much needed boost to the financial sector, legal firms and so on. But also in terms of occupier renewing expansion plans, looking again at this region back into growth and expansion mode. Although the outlook for the world isn't as rosy, I have to say, as I would like at the moment, and I don't think that we're likely to see any material recovery until the early part of next year, I do believe that when recovery does start to happen, Asia is going to benefit first, and it will benefit strongest, and it will benefit longest from the long-term upswing that we see around this part of the world. And as a result, I think we'll see more activity from international capital, certainly, but particularly Asian capital moving around the region again.